Well, everyone, what another crazy day it was today in the markets. And it seemed like no rally is safe. And it seemed like every time it looks like we're about to recover, bam, the hedge funds come in and dump on everybody. And it's looking like we're finally starting to see this super bubble burst. But in today's video, I'm going to go over something a bit different. I'm obviously going to report on the news today and what happened in the markets. But what many people are wanting to know is, okay, well, when are you going to start buying? When do you think companies are good value? And what is your plan to profit from this crash? Well, everyone, that's exactly what we're going to get into in today's video. So let's not waste any time. Let's get straight into it. Okay, so first things first, what happened in the markets today, everyone? There was a big rally in the down across all the indices. They were up around 1.5 to 2%. But again, we saw about another 750 point swing and the Dow actually ended up closing in the red. The same thing happened in the S&P 500, about a 2.5% swing. And the Nasdaq, the high growth tech stocks, just completely keep getting hammered with another 3% swing today. And look at this. This is the Russell 2000 index. This is a small cap, and this is the first major index to officially enter in a bear market, down 20.8% from its all-time high. And this is exactly what I've been warning about, everyone. I've been saying many stocks have already crashed, but it's just a few of the big, large caps in these indexes that are holding the indexes up. And they are the last line of defense. And when they fall, the whole index is going to be coming down. I think the crypto people say, exactly as I predicted. But we also got some new news today that shows that the bubble is bursting. Look at this, everyone. Look at this. Robinhood shares tank after it loses users and forecasts weak revenue. This is what I've been warning about. It's going to be coming, everyone. Look, their shares are down 12.5% in the after hours. And this is why last year in August, I was warning that we're in a crazy bubble. Look at this. Robinhood is down 83% from their all-time high after they IPO'd. I don't know about you, but I'm getting deja vu that this is exactly what happened in the dot-com bust. Look at this. Tesla is down 11.5% today. Because what normally happens with cycles and stock market sentiment is these profitless companies, these high growth, high risk companies, they're the first dominoes to fall. But eventually this will start to lead to the mid-cap stocks and the safe haven large cap stocks. And that's when we're really going to start seeing blood on the streets. What we're starting to see is, everyone, the dip buys, they're nowhere to be seen. And we're seeing if you do buy the dip, you're getting wrecked because it just keeps on dipping and dipping. And it's looking like people are just catching falling knives or the dip is turning into a rip. So the $1 million question we all have to ask is, how far will it go? And when will be a good time for us to start taking advantage of this market crash when there's blood in the streets? Because many people say, look, you can't time the market. And, you know, like Warren Buffett says, just buy, keep buying no matter what. But remember, Warren Buffett, he's sitting on $150 billion worth of cash and he isn't buying right now. And guess what? It's true, you can't time the market. It doesn't mean you can't get a rough idea of where we are in the cycle. And in 2021, it was so obvious that we were in a bubble with stocks going up hundreds of percent in weeks, with people buying doggy coins, with people paying millions of dollars for pictures of rocks. Companies that don't even have any earnings or aren't even making any profit valued at hundreds of billions of dollars. We saw stories like what we saw in the dot-com bubble of people becoming millionaires overnight, like the Dogecoin millionaire, but he got wrecked and he lost pretty much everything. So while we can't predict the future to exactness, we can learn lessons from history to give us a rough idea for what we may be facing ahead. Okay, everyone, this is a very interesting article and it gives us some great lessons. Valuation, history, bursting of bubbles in search of the flaw. Yes, that's what we want to know. Where is the flaw and what can we learn from history and previous bubbles bursting? Listen to this. Investors are starting to appreciate the precautious situation of extended valuations mixed with runaway inflation and a labor market that gives Federal Reserve cover to tighten dramatically. Earnings will be important, but ultimately we need to see valuations come in more before we bottom out here. And that's exactly right, everyone. And this is what I've been talking about, the Shiller PE ratio. Right now, it is at 35, the second highest in history, only besides the dot-com bubble. So let's have a look at a model to see how much prices have to fall for us to get back to the average PE ratio. One simple model is price versus profit. The Nasdaq 100 trades at 25 times forward earnings, down from 30 at the end of 2021. In the past two major sell-offs, the price to earnings ratio fell at least to 18 and was as low as 16 before a meaningful rebound started. So at the current earnings forecast of $569 per share, the index would need to fall more than 25% before the PE hits 18. So what that means is, even though the Nasdaq is down 15% year to date, we still have about anywhere between 15 and 25% to go till we get back to fair value. So all these people who've been telling you to rush in and buy up all these dips over the past week, people, we still have a long way to go. But let's look at the major index, the S&P 500. Another framework is history. The market's capacity to tank while the Federal Reserve withdraws stimulus was demonstrated in the fourth quarter of 2018, when the S&P 500 slid within points of a 20% correction. That sell-off, the worst of the post-crisis era before the coronavirus pandemic, was a brutal test of trader fortitude. It saw the S&P 500 plunge more than 2% 8 separate times. Now, based on earnings, stocks were cheaper in those days, roughly 20 times annual earnings when the rout began, compared with more than 26 at the end of 2021. So this is what I've been talking about, and this is what I've heard many people compare what's happening now to 2018. But like we see here, valuations are much higher than they were in 2018. They're 26 times instead of 20 times in 2018. Also, when they were tightening in 2018, they didn't have inflation to deal with. So when things went bad, they could reverse course. But now they can't do that. And not only this, the Federal Reserve's balance sheet is double at $9 trillion compared to $4 trillion it was before. Now listen to this, everyone. This is very interesting. Art Hogan, chief market strategist at National Securities, said he's looking for a few factors for signs when there might be a respite. For one, finding a reason to bounce has a lot to do with how quickly the market fell and how much damage has already been done. The average stock in the S&P 500, this is what I've been talking about, people, is down about 30%. So the average stock is already in a huge bear market. So what my plan is, and this is not financial advice, everyone's situation is different. You may be 21 years old and living in your mum's basement and have no responsibilities, and you can just keep piling into the markets no matter what. Or I have viewers here that are 65 and are on the verge of retirement, and they can't take the same risks as someone is that's 25 or 30. And unfortunately, in the finance space, a lot of the people on YouTube in personal finance are very young. So their advice that they're giving isn't applicable for an older audience. Now, again, nobody can time the market or time the bottom, but you can get a rough gauge. And what my gauge is, I think we could easily fall 25 to 30% in the S&P 500 because valuations are so much higher than 2018 when the Federal Reserve last lifted interest rates and stock fell 20%, and also inflation is much higher. So they're going to have to lift interest rates much quicker. And also, like I've been talking about, if this leads to a full-on recession or a depression, we could see stocks fall further, even 50%. So that doesn't mean I'm going to go all in when it falls 25 to 30%. It just means I'll start dollar cost averaging in and testing the waters, and remember how quick things can change in the markets. Just last month, things were looking very bullish, and now things are looking like, the end is near. So when we do get to that point, I'll have to look at what the data is saying, what the macroeconomic picture is looking like, and then we'll have a clearer picture if this is the bottom or if there's more price falls coming. But don't worry, when that time comes, I'll definitely let you all know. So everyone, that was just a quick update with what's happening in the markets today, some of my thoughts on how much stocks could fall, and what my personal strategy and plan is to start investing in these markets. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you in the next video.